Well, hello there, and welcome to today's presentation. This is a PowerPoint presentation focusing on why you should invest in real estate. Now, this presentation has a couple different purposes. It can be used for educating yourself if you are a novice investor just getting started and you want to get a better handle on the benefits of investing in real estate. And if you're a more active, advanced real estate investor, then this is a great tool that you can make use of to help you raise capital. For a lot of people who are potential investors, they don't really understand real estate investing. Their perception that real estate investing can be or is very risky. So this is a tool that you can make use of to help educate them with respect to the value and benefits of investing in real estate. So having said that, let's get started in this PowerPoint presentation. So why invest in real estate? Great idea, but real estate is risky. It's so speculative. I have to deal with tenants, and I hate dealing with tenants. It's just way too expensive to get involved in. So this is a lot of the feedback you're going to get from people when you introduce the idea of investing in real estate, or maybe this is the perspective you have as well. So what are the options out there? You've got some money to invest. Where do you put it? Well, for most people, they simply look at the local banks, in the savings accounts, whether they GICs or savings bonds with the government, or they might be, interested in putting it in the stock market, so they register and they start playing in the stock market. Or maybe they don't really know much about the stock market, but they understand that that's where that you should put it. So a lot of people have been led to believe that they should just hand their money over to the mutual fund market groups. There's a variety of different groups across North America that invest in the mutual funds, which is in effect putting it in the stock market, but instead of putting it in one particular stock, you're putting it into a group of stocks inside one particular fund. Then there's REITs. REITs aren't overly popular or common with the average investor, and what a REIT is, effectively, it's like a mutual fund, except that inside the mutual fund it's real estate. So it's a real estate investment trust. It's a group of real estate related products that are put together in one fund, and you can invest in that. Or you can invest in business. You can either start your own business, or you could partner with somebody to start a new business. And then finally there's commodities like precious metals and oil, gas, etc. So let's take a look at some of these savings options. So when you're taking a look at your bank savings or your government savings bonds, today they're typically paying out 1 to 2% interest rate. However, that also depends upon the balance that you're carrying in those accounts. So they want to make sure that to pay out the highest rate of 2%, they want a minimum amount in the account, and they want it locked in for a period of time as well, a year to 5 years. The rate of inflation is 2%, and that's what they claim it to be. And again, that rate of inflation goes up and down. So even if it was 2%, the return that you are receiving on your money in the bank account doesn't even keep up with the rate of inflation. But the true inflation rate is more likely in the 7 to 8% range. Because the governments like to manipulate what they report to you as inflation, so they exclude a lot of different expenses that we typically use. I mean, if you go back to the early 80s, the way they calculated the inflation rate was very different from the way they calculate it today. So today's calculations represent a much lower inflation rate, which is much more appealing to the general public. But in reality, when you start taking a look at your fuel prices going up like they have periodically, or your utility charges going up, they're going up far greater than 2%. So when you're investing in these low interest return accounts that are paying out 1 or 2%, you're actually losing money. So then we take a look at the stock market. Now with the stock market, it typically goes up and down, and it can go up and down very drastically in very short periods of time. In this particular snapshot of the stock market, this is the S&P 500 from April of 2000 to 2012. And over that period of time, if you'd put $100,000 into the fund at the beginning of this period, it would actually have shrunk by 16%. So the only way people's portfolios are growing in this type of market is if they keep putting more of their own money into it, which isn't getting a return on their investment at all. So stock market busts, can they actually disappear? Absolutely, they can disappear, and it's shocking to people that their investments can actually just evaporate like that. Yet when you take a look at some of the more famous companies out there that have gone bust, like Nortel, Lehman Brothers, Enron, Bear Stearns, these companies have just disappeared. They're no longer on the stock market. So if you were unfortunately investing in any of those particular companies, your money has virtually gone. So you better put your money in, say, the mutual fund market. That's better than putting it in the stock market. Well, yes and no. It is a little bit more secure because, as I said before, in the mutual fund market, what they're doing is they're taking a group of stocks. It could be 6 or 20 different stocks. They will group those together and put them into a fund. And then what you do is you invest in the fund, and that fund will invest in that variety of stocks. So if one stock goes up and another stock goes down, they're going to take the average on all of the stocks within that fund to generate a return for you, the investor. The challenge is that they've got a ton of fees attached to these things as well. So there's fund managers, people who are managing these funds, and then there's the people who are selling the mutual funds to you, the investor. Every person that's involved gets a little cut of the action. So when you start the investment, there could be some front-end fees, there could be back-end fees, there could be monthly fees. And the reality is all of these fees you don't really see, because what they do is they take these fees off of the return first before you see any return at all. So if the market fund is returning a 10% return, but all of the fees associated to it amount to 2%, then what you're going to see is that your fund has generated 8%. Now, 8% would actually be pretty good these days. It's more likely that you're going to see returns down around 2 to 5% on average. Now, your return on investment is actually determined by your risk tolerance as well. So if you have a higher tolerance for risk, then what you can do is you can invest in a mutual fund that contains more volatile products in there that potentially pay a higher fee, but they also have a higher risk of going to zero as well. Or if you have a lower risk for lower risk tolerance, then what you could do is you could invest in a mutual fund that has very safe, secure products in there that pay a much lower return. So you're going to have a much lower return on your investment as well. Then it's also dependent upon the mix that's inside your mutual fund, and this is going to be dependent upon the manager who's managing these funds and selecting the products to put into that particular fund. And then, as I mentioned earlier, there's the management fees that come right off the top. So how about REITs? Investing in a REIT, which is a real estate investment trust. This is very similar to your mutual funds, except that instead of it having other stocks from companies, it's got real estate portfolio. So it could be apartment buildings, it could be commercial strip malls, it could be industrial parks. It's all made up of different types of real estate. So depending on the type of real estate that's inside the fund will dictate the return that it generates, which will also dictate the risk inside those as well. So very similar to your mutual funds, and it's only as good as the manager who's actually picking the properties and managing those properties as well. Similar to mutual funds, there's management fees that come off the top, and you're really only enjoying one profit center, and that's the cash flow that it potentially generates. What are your business options? So next is your business as an option, but here the challenge is that most businesses 20% of most businesses will fail in the first year of operation. 50% will fail after 5 years, and 70% will fail after 10 years. So investing in businesses requires a lot of work, which long hours, low pay, and high risk of failure as well. This is definitely not for everyone. You need to be a true entrepreneur willing to put in those long hours and accept low pay initially with high risk. And bottom line is, what you're doing here is you're creating a job for yourself if you're starting the business yourself. Then with commodities, so in particular silver and gold, commodities are driven by market conditions, supply and demand. They may not, and most often they do not generate cash flow. They'll only increase in value through appreciation or when the market shares go up. So these are what we call a good insurance investment. So if the market crashes, then commodities like silver and gold will typically go up in value, so that those increase in values can help offset any losses that you might experience in some of the other stocks. Then real estate. Now real estate is one of the basic human needs we all need. We need food, shelter, clothing. So real estate provides that shelter. There's always going to be a demand, and this demand is actually growing as well. So the percentage of people, and this is an approximation, approximately 40% of the population are renters. That changes from market to market, but overall 40% of the market is a rental market, and it's growing because more and more people are finding that they cannot afford the high cost of home ownership, so they are staying as renters. And also, we're at the leading edge of baby boomers now. A lot of baby boomers are selling their homes because they can't maintain and handle the maintenance issues of a house, so they want the flexibility of no maintenance and being able to lock the door and travel south, for example. So in the past, a lot of the seniors have been looking to downsize into condos, but the high cost of condos and the condo ownership is making that undesirable as well. So there's more and more people looking for good quality rental properties in their retirement years. The nice thing about real estate is also it's solid and tangible. You can actually go out and see it and touch it. The banks love it because they deem it to be safe and secure. Your piece of real estate is not going to disappear like the Lehman Brothers disappeared off the stock market. Your piece of real estate is not going to disappear. The only way it could potentially disappear is if there was a natural catastrophe or it burnt down. Well, that's why you have insurance. So real estate is insurable. So it provides you safety, security, it's tangible, you can see it and touch it, it feels good. But I know, I've been told, it's risky, it's speculative, and you have to deal with tenants, and it's way too expensive to get in. Well, let's take a look at some of these excuses. Let's take a look at risk first of all. If you were learning to drive a car, but you had no knowledge about how to drive a car, that would be considered very risky. But as you learn, you take lessons, you gain experience, it becomes less risky. Or investing in the stock market. That can be extremely risky if you don't know how to invest in the stock market. So again, knowledge plus experience reduces risk. So the thing is that you need to learn how to invest in real estate properly. You need to gain the experience over time or partner up with somebody with experience. Learn from those who have the experience. By doing so, you are reducing the risk. Investing in real estate can be very low risk investments because it's a tangible asset. You can get out there and touch it, see it, feel it, and it's insurable as well. All right, but real estate is speculative. That's all I hear, that there's these real estate speculators, and this is true. That is what we call flipping, where you go out and you buy a property, you sit on it for a short period of time, maybe 6 months to a year, and then you turn around and sell it for an appreciated price. That's speculating. That's really no different than putting your money into the stock market, hoping that the stock is going to increase in value. There's a lot of money to be made in that. Unfortunately, there's also a lot of opportunity to lose money there, because you don't know if that real estate market is going to continue to climb or plateau or actually drop. So again, knowledge plus experience can lower your risk, because there is a time to flip and there's a time to get out and avoid flipping. That's why when I myself as a professional investor, I focus on buying for cash flow. But you have to deal with tenants. Absolutely. But tell me what business or industry has zero challenges. You're going to have challenges in every business and in every industry. Tenants just happens to be one of the challenges we as real estate investors have to deal with. To mitigate that, good screening can really help. Learn how to screen and pick good quality tenants. Or you can simply hire the services of a professional property manager, somebody who has been there, done it, and knows how to take care of the property and deal with those tenants for you. Or you could potentially joint venture with a hands-on investor. You understand the benefits of investing in real estate, but you don't have the time to find the deals, you don't have the time to structure the deals, and you definitely don't have the time nor the desire to manage the properties, especially dealing with the tenants. Well, this is where you could joint venture with somebody else who has that skill set. Maybe they don't have the cash, or they've run out of cash to buy any more properties, but they're a really good hands-on investor. You partner with them, you do a 50-50 joint venture or whatever the split works for you, and you can move forward dealing with real estate. Too expensive? Well, yes and no. Prices vary across the country. They also vary according to the class of the building, and it's sort of relative as well. I mean, as the cost of real estate increases, so does the revenue that it generates. So generally speaking, if the rents go up, so does the value of the building. So it all depends on the type of building you're buying. If you're buying a Class A building, it's going to be extremely expensive, but you're going to get higher rents than if you were renting to a Class C building. So it depends on what it is you're looking for. It depends on the market you're looking to buy into. Plus, there's always the opportunity to use other people's money. Other people are interested in lending their money at very reasonable rates of return to partner with you, which will allow you to get into some of these more expensive properties, or properties that you don't have any money yourself to invest in. All right, so real estate, I believe, is a game changer. So ask yourself this, or ask your potential joint venture partner investor, how many profit centers does a bank account have when you are putting your money into the bank account? It has one. If it's paying out 2% interest, that means you're going to get a cash flow equivalent to 2% annualized every month. Or the stock market. Well, depending on what you're investing in the stock market, there could be cash flow, there could be dividends or appreciation, so there's one or two profit centers. The mutual funds, you basically just have appreciation. As it goes up in value, it only gives you cash flow if and when you cash out. So it's got one profit center. REITs, the same thing. You're basically investing in that for appreciation. Businesses can have one or two, possibly three different profit centers, depending on the type of business that you are investing in. With precious metals, it's only appreciation. If it goes up in value, that's how you make your money. However, when you invest in real estate, you've got a lot more flexibility, and you actually have 7 different potential profit centers. And that's what we're going to talk about next. So we're going to talk about all the different profit centers related to real estate. First profit center is cash flow. Now, when I buy an investment property, I always focus on cash flow first and foremost. If the property is not going to cash flow, I'm not going to buy it, because I'm not going to buy it simply based on appreciation. So what is cash flow? Cash flow is the difference between the money that you collect related to that property, such as your rental income, versus all of the expenses related to that property. So all of the property tax, the property insurance, the maintenance, the property management, all of those expenses related to that property have to be paid for from the cash flow of that property, or the revenue of that property, and the money that's left over is your cash flow, the money you can spend on a monthly basis. Then the next profit center is called instant equity. if you're an astute investor and you're able to negotiate a really good deal or identify a really good deal that's for sale below market price, then that difference between the market value and the price that you pay is called instant equity. So as the example here on the screen, if the list price is $325,000 and it's truly worth $325,000, but for whatever reason you're able to purchase it for $300,000, then that difference of $25,000 is instant equity. That instant equity is going to be going straight towards your net worth statement. So that's going to increase your net worth, which is going to help you qualify for future mortgages in the future as well. Why would somebody sell for less than what the property is actually worth? Well, they may not be aware of what the property is worth. They may not be aware that you could change the use of a property to make it worth more. They may be motivated to sell it because they're going through a divorce and they need to sell the property quickly, or they've been relocated for jobs, or their business venture has gone south and they need to liquidate in order to get some cash quick in order to avoid bankruptcy. There's a variety of different reasons why people will sell for below market value. Then there's leverage. So if you have a $300,000 asset, whether it be a house or an apartment building, whatever it is, and you can go to the bank and the bank will say, yes, we will lend against that property. We will lend you 80% of that value. Therefore, you only need to have 20% loan to value in cash. So in this example, if it's a $300,000 asset, you're able to purchase that property, have your name on the title, and control it for as little as $60,000. Now, this is a really good question to ask your potential investors when talking to them about investing in real estate. They're going to say, oh no, I'm going to keep my money in the mutual funds. I feel safer there, and the banks love them, and they're safe and secure. Well, if they're so safe and secure, will the bank lend you 80% of the value of those stocks you're buying? No. The bank won't lend you anything unless the money they lend you is secured against a hard asset such as your house or another hard asset like an apartment building or something else that you own. The bank will not lend any money secured against the mutual fund or the stock that you are buying. You have to pay 100% of the value of that stock or mutual fund. So the banks that are selling these stocks and mutual funds don't have as much faith in that product as they do in real estate, and that's why the banks are more comfortable lending against real estate. So if the banks are comfortable lending against real estate, then why shouldn't your investors feel more comfortable lending against real estate as well? Then we have appreciation. Excuse me. Now, over time, property will increase in value on its own, providing you maintain it and take care of it. Now, if you don't take care of your property, it will not appreciate at the same level because it's going to get tired and run down and just literally fall apart. And we've all seen those types of properties. However, if you maintain it and take care of your property, over the course of time, it will increase in value, doing nothing else but just maintaining it. In this particular example, we can see that from 1975 to 2009, the properties have increased on average 6.2% annually. So what controls appreciation? Well, there's the economy. If you have a poor economy, fewer jobs, so people move away, the property can actually depreciate. If you have a booming economy, people moving in, it can appreciate. If you have high interest rates, they're less affordable. So if you have higher interest rates, that go up from 3% to 5%, that's a $325 a month difference, $3,900 per year. That's going to cause the value of the property, the investment property, to go down as well. If you have market oversupply, so supply and demand, if they overbuild in a neighborhood, you see this in subdivisions and towns that are going through a bit of a boom. There's all kinds of construction going on, houses being built. All of a sudden things start to slow down, yet there's this a big supply of houses still being built and that have to be finished, yet the demand has gone down, so values can go down. Or on the flip side, you could have great demand where there's new industry, new jobs being opened up all the time, and the developers can't build houses fast enough. So as a house comes on the market, people are scrambling to buy it, and they're overpaying for it. The physical condition, as I mentioned earlier, if it gets run down and tired, or if it becomes non-functional. Non-functional, for example, could be if you back in the 70s, you built a storage building, and the storage building had 10-foot high ceilings, which worked quite well back in the early 70s. Well, today, with newer technology and equipment, they now need 16-foot high ceilings. So that 10-foot high building is not as attractive to rent out to new industry today. So it becomes non-functional. Here we have a picture of a house that has been maintained, is going to increase in value on an annual basis versus something that gets tired and run down. So this leads us into depreciation. This property is actually losing value over time. So with depreciation, the government recognizes that if the property is not being taken care of, it will lose value over time. Or it could be another asset. So for example, if you when you go out and buy a brand new computer for $1,000, well, the next year it's not worth $1,000. It might be worth $600, and within 2 or 3 years it might be worth next to nothing. So the government will allow you to depreciate that particular asset at a much higher rate than 4%. It depends on what the asset is, will dictate what the rate of depreciation will be. The longer the lifespan of the asset, the lower the amount of depreciation, which is why with real estate the depreciation is only 4%, because the government realizes that that asset should last a long time, 40 or 50 years, but it's also going to lose value if it's not taken care of. So what they will allow you to do is they will allow you to depreciate the improvements to the land, in other words, the building. They don't allow you to depreciate the land because in the eyes of the government, land does not lose its value. So if you purchase a property for $300,000 and the valuation for the land is $100,000, that means the building is worth $200,000 for the purpose of depreciation. So you can depreciate that building $200,000, 4% annually. That means in the first year you can depreciate $200,000 at 4%, or $8,000. That $8,000 is comes off your taxable income, so it can help you save taxes. The second year you depreciate another 4%, but it's on a declining basis. So yeah, it's going to be $200,000 minus the $8,000 you deducted the year before. So that second year you can only deduct $76.80. This goes on and on year after year. You can't depreciate more than 4%. You can choose not to depreciate on year 3, or you choose to depreciate 2%, should you choose to depreciate at all. And the reason I say should you choose to, it may or may not be in your best interest, because there's a little something called recapture. And what this means is that at the end of say 10 years, if you've depreciated your property a total of $50,000 for tax purposes, when you sell that property you have to add that $50,000 back into your tax payable. You have to pay the tax benefits back to the government. So that's what we call recapture, and this is why you need to make sure that you talk to your accountant. However, when you talk to your accountant, some will say, oh, you should depreciate, some will say you don't. It all depends on your plans, your goals. Simply ask yourself a question though. Is $1 today in your pocket the same value as 10 years ago? And what value will it be in the future? So if you can put more money in your pocket today and get that money working for you today instead of in the government's pocket, then it might be smart of you to depreciate your properties. But if you're planning on selling the property in a year or 2 years and it's just a short-term hold, then it's probably not to your benefit to do that. So it's definitely an important topic to discuss with your accountant. And don't go talking to your accountant unless you have a really good, clear plan. Like your accountant's going to ask, well, how long are you holding it? And if you say, I don't know, well, then the accountant can't give you an answer. You have to have clarity with your plan. Next profit center is called principal paydown. This is directly related to your mortgage, the debt service on your property. So when you make a mortgage payment, in this case, if your payment is $1,180, it's made up of two portions. There's the interest portion that the bank, the lender, is charging you for the use of their money. And then the second portion is called a principal reduction. In this case, $495 is going towards the reduction of the debt that you borrowed. So your annual payment over the course of the year is $14,160. The principal reduction is $6,000. The question is this taxable income? Now, when I ask this question at live events, it's usually 50-50. Half the room says yes, it is taxable. The other half say no, it's not taxable. The reason why people don't think it's taxable or don't realize the taxable consequences is that they don't see it. It's not cash flow. It's not money going into your pocket because you've made a payment to the bank and you've reduced the debt on the property. But the reality is this is taxable income to you. So when you do your tax filings at the end of the year, you have to take your annual cash flow that you've collected over the course of the year and add to that your principal reduction, and that is going to give you your taxable income for the year. So from a graphical perspective, here's your mortgage. You've got your principal portion pay down at the beginning, but over the course of in this case it's a 30-year amortized mortgage, over the course of the 30 years you can see that the interest portion starts to decline and the principal portion increases. But the turning point about year 2021 is when it's 50-50. So 50% of your monthly payment goes towards debt reduction, 50% goes towards interest payment. The reason the banks have it structured this way is that they know most people will not hold their properties for 25 or 30 years. They're counting on you selling your property within, the average is 7 to 8 years. So if you sell your property within 7 to 8 years, then they've collected the lion's share of your mortgage payments in the form of interest, which is profit for them. And it's very beneficial to the banks when you sell it early like that. The banks lose money after year 21. You also have equity growth during this time as well, during your principal pay down. So here the mortgage is being paid down over the course of 25 years, the amortization, and this line here is the appreciated value. So over time it's going up in value by 3 to 5%. So the area in between is called dead equity. That's your equity growth. So you can see at the very beginning, in this particular case, it looks like it's about $25,000. That has grown all the way up to $340,000 in year 25. So equity investment. So that dead equity is just sitting there doing nothing. What if we were to take $60,000 to buy a house worth $295,000, just as an example? We then renovate the house and put a suite in it for an additional $30,000. We could use a line of credit or a second mortgage for the down payment and the renovations costs. So all that debt equity that we're building up in one of our other properties, we can access it through a line of credit or a second mortgage registered against that other property. We then take that cash and we buy this $295,000 property and we suite it. So this is a typical property. This is actually a property that one of my students purchased. And in this particular case, they got a mortgage for 3.5%. So it was $1,180 was the monthly payment on this property. Their property tax was $170 a month. The insurance was $100 a month. So their total expenses were $1,450. The income that it generated was the upstairs and the garage rented out for $1,300 a month. The basement rented out for $900 a month. for a total gross income of $2,200 per month. So the cash flow in this particular case, there's our gross income, less all of our expenses, is approximately $750 per month. That's a pretty good deal. Or works out to be $9,000 per year. So let's take a look at the return on our investment. So just as a reminder, the return on investment is calculated by taking your return, the money that you generate from your investment, and you divide that by the initial investment. That's going to come out into a decimal format. So you multiply that by 100 to put it into a percentage format, which is what we're more accustomed to seeing. So in this particular case, we have $9,000 a year coming in, and it cost us $90,000 to purchase the property and renovate it. We multiply that by 100, and it works out to a 10% return. Now, I think most people would be pretty happy with a 10% return just based on cash flow, But is it really a 10% return? Well, we did the math and it looks like it should be at 10%. The question is the annual cash flow actually $9,000? So where did that money come from in the first place to buy this property? So we've got our annual cash flow, but we borrowed that money. That $90,000 we actually borrowed. So it might cost $3,000 to borrow it. So our actual cash flow is going to be the difference. It's only $6,000. All right, well, let's take a look at the return on the investment for our $6,000 then. So we take the $6,000, we divide that by $90,000, and we come up with a 6.67% return. Not nearly as good as a 10%, but I think for a lot of people, that's still a pretty decent return, better than what they're going to get in the banks. Keep in mind that's only based on the cash flow. There's other profit centers we haven't talked about as well. But I've got a question mark. Is it really 6.67%? Again, the math says it is. However, how much money have you actually invested of your own? You borrowed the money from the bank, secured by your asset, and you're paying for the use of that money to invest in another deal. It's not your money. So you actually have $0 invested in this transaction. And when you do the math for that, it comes up to an infinite return. And this is ultimately what you want to achieve investing in real estate. All right, so quick review. From the perspective as a homeowner, if you own your house, are there profit centers for cash flow? No, because you're not paying yourself rent. How about appreciation? Yes, there's a profit center for appreciation. Leverage, for sure. The banks will lend you money. Depreciation. Well, in Canada, you're not able to deduct the cost of your mortgage for tax purposes, so not there. But in Canada, but in the U.S., you can take advantage of that a little bit. So there is some tax savings there. It's not directly called depreciation, though. Instant equity, absolutely. Principal reduction, for sure, because every month you make your mortgage payment, you are paying down the mortgage, the debt. So that's a profit center. And then the reinvestment, for sure, because as you pay down the mortgage on your house and you maintain the house and it goes up in value, you're building up that equity in the property. You can leverage that debt equity to purchase other properties. Now, when you look at it from an investment perspective, if you go out and buy a rental property, then there's the cash flow, appreciation, leverage, depreciation, instant equity, principal reduction, and reinvestment. So that's it for the profit centers and why you should invest in real estate. I think that's a pretty strong argument about the benefits of investing in real estate. Are there risks investing in real estate? Absolutely. But there's risks in everything we do every day. There's risks when we get in our car. Probably the riskiest thing we do is getting in our car and driving every day. Yet we do it without second thought because we are educated and we are experienced. So get the education, get the experience, or invest with somebody who has the experience and the education and start leveraging your money into real estate where you can enjoy all of these profit centers. Thank you very much, and take care, and we'll see you at the top.